Welcome to the 3-Edge Week in Review for the week of June 16th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Lawrence Jules, a special guest. Lawrence is our head trader and member of the investment committee here at 3-Edge Asset Management. And the reason that I wanted Lawrence to join me for this week's video is because we're going to discuss a topic that has received a good deal of investor attention recently and unfortunately also generated some amount of misinformation, which has led to investor frustration. And that is today's topic, which is Defined Outcome ETFs. These are sometimes referred to as buffered ETFs. And with the U.S. equity markets once again approaching all-time highs, and with investors facing what seems like an ever-increasing amount of economic, market, and geopolitical uncertainty, being able to invest in an instrument which purports to put a floor on how much an investment could lose in a market downturn, well, that sounds pretty interesting. And that is where defined outcome or buffered ETFs come in. And just like any product that comes out of Wall Street, it is essential to understand how these products actually work. And Lawrence is just the person to discuss this with. He's as knowledgeable as anybody I know on Wall Street when it comes to understanding the entire ETF ecosystem. Lawrence has over 25 years of hands-on investment management and trading experience. And before joining 3Edge, Lawrence was at Charles Schwab Asset Management, where he served as head trader of Charles Schwab's separately managed account products. So let's get started. Lawrence, thank you for joining us here today. And to get started, maybe if you could just give us, explain what is a defined outcome ETF, how do they work, and maybe even a simple example.
Sure. Thank you, Fritz, for having me. Buffered products, as also known as defined outcome, they provide exposure to an underlying index, such as the S&P, for example, but with a certain level of downside protection, along with a cap level at participation over a specific period time frame. Now, what that simply means is that you can go out and buy a product that allows you to minimize the amount of loss that you experience while capping your upside. An example would be you could buy a 15% cap, 15% downside buffer with a 12% cap. So what that means is if you bought the buffer in January, it would reset at the end of December 31st of that same year. If the market were to go up 20%, you would only be up 12%, foregoing 8% on the upside. However, if the market were to go down 20%, you would only be down 5%. Because that 5% buffer would absorb the first 15% loss. Therefore, you would only have a 5% loss. On the other hand, if the market were to drop 30%, you would still experience a 15% loss. Again, you're buffered on the first 15, but you're absorbing the other 15% loss. So that's the way these products are designed. The other thing to keep in mind is the vast majority of buffers are created using what they call with options. So they don't necessarily hold actual underlying securities except for a few exceptions. So that's also important to understand.
All right, excellent. So now that we have a better idea of what these are, what they're supposed to do, and an example, why don't you just list, okay, so what are some of the advantages of using these products, and what are sort of maybe not disadvantages, but what do you need to be cautious of or aware of in terms of using the product?
Sure. The biggest advantage to buffer products for investors is that it allows you to know in advance how much risk that you're taking off the table. So if you bought a 15% buffer, then you know, regardless what happened to the market on the downside, the first 15% loss you will be protected from. So that's a major advantage, and that's one of the reasons that clients like them. The other thing is clients like them because it allows you to have a product that allow you to know from one period to a next period how much protection you're going to have during that particular period. The downside, of course, is you're foregoing a certain amount of upside on the particular market. But I think also one of the key things to understand is timing. When you're buying a buffer product, it's extremely important to understand that In order for you to achieve and earn what the product defined as, hey, 15% downside protection, say 12% cap is, you have to hold the product over the entire outcome. That means you have to buy it from the time it was issued and hold it till it reset. And the reason that's important is because intra-period, it does not mean that you are not going to be subject to market volatility. If the market dropped 20%, intra-period, you could be down as much as 10 to 11%. The key is to not panic and to continue to hold. So it's important just to always remember the actual buffer works if you hold it for the entire outcome period. So one quick example is if you bought a buffer that's already up, let's say 5% from where it was issued, and then the market would have a downturn and went down, say 20%, right? You would absorb the first 5% loss. Right. And then the buffer would kick in, and then you would absorb another 5% on the back end. So if the market were to drop 20%, you could be down 10% because you bought it 5% above the buffer price. So it's important that you're buying it at a point where it's at the reset stage, that you're not basically taking any buffer. You're not taking on any risk.
All right. Excellent. That's great. So, we do, I guess how I would describe our use of these products as, we're agnostic. They're a tool, you can use them. And maybe it would be helpful if you explained how we might use a buffer product, because I think it's a little bit different. We're sort of trying to take advantage of some of the intricacies of these products. So what would be an example of how we here at 3 Edge would potentially use a defined outcome ETF in our portfolios?
Sure. We're major users of buffers. Now, the way we look at buffers is, one, we're agnostic as to issuers. 2, we tend to perform a detailed analysis of the buffer, but particularly focusing on understanding the underlying basket, the options that makes up the buffer. And 3, we tend to focus more on owning quarterly buffers or buffers that only have 3 months left to reset. So those are really key things that we look at. One of the things that we tend to focus on is understanding the lag in performance in buffers. And that's one of the reasons we focus on owning buffers that are quarterly or 3 months. So a good reason for why we might buy a buffer might be the market, is rallying, but we're not convinced, say, that the rally is for real, but we want to remain in the market. So we may decide we want to buy a buffer. But before we buy a buffer, we generally approach it with specific risk parameters and characteristics that we want to have in that particular buffer. So in an example would be, we buy a buffer that has a 2% downside to the buffer reset, but with, let's say, a 10% upside. So what that means is we bought a buffer that max loss on the downside is 2%, but on the upside, we can capture as much as, let's say, 10% with 3 months remaining. And the reason I keep mentioning the amount of time remaining is because the lag in buffers is heavily dependent on when you buy it. It's not uncommon to buy a buffer in January, if the market were to be up 10% by March, for you to only be up by 5. Or if the market were to drop 20%, for you to be down 11%. So owning a buffer intra-period doesn't mean it's going to save you from the natural emotions of looking at losses as an investor. So those are the approaches that we take when we think about buying buffers. We have very well-defined risk parameters before we go out. And again, we have very good understanding of the structure of the basket of the ETF, the options themselves, and how those options are going to behave the last 3 months versus the first 3 months. And that's how we decide what buffers we're going to use and when we're going to use and how we're going to use them.
All right. Excellent. Thank you for that. I mean, it does seem to me that for individual investors, the safest way to do this is to buy it right at that reset and commit, to actually holding it until the next reset period. But this has been really great. But why don't we wrap up? Why don't you just provide, a few, what are the key takeaways, or what are the most important things for investors to understand when they consider including these in their portfolios?
Understand what you're buying. So when you look at the product, understand that the cap, what your cap is going to be and what your buffer is going to be. But I would say the key takeaway from this video is timing is key. Timing is key. You got to understand the outcome period. You got to make sure you're buying from the point when it was issued and holding it till the point where it's going to reset. Because other than that, you could potentially experience a very different outcome from what the fact sheet says. Because you bought it, let's say it's a January buffer, you bought it in March, right? To expire in December. So it's important that you understand what you're buying, but more importantly, it's really important that you understand the timing period that you're buying this particular buffer. At what point are you buying it? How far is it from the buffer and how much remain of the cap? Those are the things I think that's important to understand.
Excellent. Very good, Lawrence. Thank you very, very much. Clearly our goal here today was to help educate and inform our listeners so they have a better understanding of these vehicles and thereby hopefully can avoid some common mistakes when it comes to investing in defined outcome ETFs. And as far as our listeners, if you are interested in learning more about these vehicles, please feel free to reach out to us here at 3Edge. We'd be glad to discuss them in greater detail. So that will do it for Lawrence and me for this week. Steve Cucchiaro and I will be back next week with another edition of the 3Edge Week in Review. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone who you think might benefit from these videos, please feel free to share them. In addition, if you enjoy the videos, please consider subscribing to our 3Edge YouTube channel. We would be most appreciative. So until next time, on behalf of Lawrence and everyone here at 3Edge, thanks for listening.